Your most expensive trade may be the one that made money. You broke your entry rule, increased the position after the market moved against you, and escaped with a profit. The account survived, but your judgment absorbed a dangerous lesson that discipline is optional when instinct feels strong. The market did not reward your skill. It financed your next mistake. This is one reason trading can be so difficult to understand. A sound decision can lose money, while a reckless decision can pay. If you judge yourself only by the result of the last trade, you begin training your mind to repeat whatever happened to work, even when the reasoning was poor. The market's deeper pattern is not a hidden sequence that predicts every turn. It is the repeated relationship between price, participation, pressure, and human response. Traders chase movement after it becomes obvious. They defend losing positions because closing them would make the error real. They take small profits quickly, then grant losses more time. These behaviors leave traces. You can see those traces when price breaks a level but cannot hold beyond it. You can see them when volume expands and the market makes little progress, suggesting that aggressive orders are meeting equal resistance. You can see them when favorable news produces no advance, or unfavorable news fails to push price lower. The event matters, but the market's response often tells you more than the event itself. That response is where observation becomes useful. If price rises easily, pauses on lighter activity, and then resumes, the path may still be supported. If every advance requires greater effort while producing less distance, pressure may be changing hands. You do not need to predict the exact turning point. You need to notice when the behavior that justified your position is no longer present. This also changes how you should interpret your own actions. Before entering, define what the market must do for your idea to remain valid. Decide which price behavior would show that you are early and which would show that you are wrong. Keep the position small enough that you can obey that evidence without bargaining with it. Risk is unavoidable. Confusion about risk is not. Then study the moments when you feel the strongest urge to interfere. Are you moving the exit because price is giving you new information? Or because taking the loss would injure your pride? Are you adding because the setup has improved? Or because the lower price makes the original decision feel easier to defend? The distinction is quiet, but it separates analysis from self-deception. To crack the trading algorithm, you must begin by seeing that there are two systems operating at once: the behavior of the market and the behavior it provokes in you. The first leaves clues in price. The second determines whether you can read them clearly. And before we examine those clues more deeply, there is one question that must be settled. When the market and your opinion disagree, which one are you actually trained to obey? You can read the market correctly and still make a poor trade. The difference is often created in the few seconds between deciding to act and receiving the fill. Price moves, the spread changes, available size disappears, and the trade you planned is no longer the trade you entered. An idea exists on paper at a single price. A real order enters a live auction. If you intend to buy at 50 but receive 50.20, the market does not owe you the missing 20 cents. Your profit potential has been reduced before the position has had a chance to work. Repeat that loss of efficiency across enough trades, and a sound method can become an unproductive one. This is why the displayed price must not be mistaken for guaranteed access. The last traded price only tells you where one transaction occurred. It does not tell you how much can be bought or sold there. A thin market may show an attractive price while offering very little size. Once your order arrives, it consumes what is available and reaches into worse prices. The spread is another cost that remains quiet until activity becomes urgent. In a stable market, the distance between buyers and sellers may be small. During a sudden move, that distance can widen sharply because liquidity providers become less willing to stand in the way. If you send a market order at that moment, you gain speed but surrender control over the price. Urgency has a price, and volatile markets collect it immediately. A limit order makes the opposite bargain. It protects the price, but does not guarantee participation. You may place an order where you want to trade, watch the market touch that level, and still receive no fill because other orders were ahead of yours or because too little volume traded there. A missed trade is not necessarily an execution failure. Sometimes it is simply the cost of refusing a poor price. The choice, then, is not between a good order type and a bad one. It is between different forms of risk. A market order risks price. A limit order risks non-execution. A stop order gains relevance only after its trigger is reached, and in a fast move the eventual fill may be far from the trigger. You must know which risk matters more in the situation before you place the order. Notice how the market is trading as you prepare to act. Is volume steady or arriving in bursts? Is the spread stable or expanding? Does available size remain on the book or vanish when price approaches it? Is the instrument active enough to absorb your intended order without forcing price away? These observations tell you whether the market can accommodate your execution plan. Your own size also changes the answer. An order that is insignificant in a liquid instrument may be disruptive in a thin one. As size increases, the average fill can worsen because the order must travel through several price levels. The chart may show one entry, but your account receives a weighted average of every price required to complete the transaction. Execution should therefore be judged against a clear benchmark. Record the price available when the decision was made, the expected spread, the actual average fill, and the time required to complete the order. The purpose is not to demand perfect fills. Perfection does not exist in a moving market. The purpose is to discover whether your method repeatedly gives away more than the opportunity can afford. Before sending the next order, ask one practical question: does this trade require immediate participation, or does it require a specific price? That distinction determines what you are willing to sacrifice. But even precise execution cannot rescue an idea whose numbers were never favorable, and that leads to the arithmetic hidden beneath every apparent edge. A strategy can win 7 trades out of 10 and still lose money. Another can fail more often than it succeeds and remain profitable. The win rate attracts attention because it is easy to understand, but by itself it tells you almost nothing about the quality of an edge. Every method has 4 basic numbers: how often it wins, how much the average winner earns, how often it loses, and how much the average loser costs. These numbers work together. Separate one from the others, and the picture becomes misleading. Suppose, hypothetically, that 10 trades produce 7 gains of 1 unit each and 3 losses of 3 units each. The strategy wins 70% of the time, yet the 7 units gained are exceeded by the 9 units lost. Now reverse the structure. 3 gains of 3 units and 7 losses of 1 unit leave a positive result, even though most trades fail. Frequency creates the experience of winning. Magnitude determines what those wins are worth. This relationship is called expectancy. It is the average amount a method can be expected to gain or lose per trade over a sufficiently large series. Multiply the probability of a win by the average win. Then subtract the probability of a loss multiplied by the average loss. The result does not predict the next trade. It describes the long-run tendency of the process. That distinction matters. Positive expectancy does not produce orderly results. Wins and losses can arrive in almost any sequence. A method with a real advantage may experience several losses in succession because probability governs the series, not the arrangement. The edge may be present while the recent results appear to deny it. Variance describes this unevenness. 2 methods can have the same expectancy but produce very different journeys. One may deliver small, regular outcomes. The other may remain quiet for long periods and depend on a few large gains. Their average return can be identical while their short-term behavior is entirely different. The shape of the distribution matters as much as the average. A method built on frequent small gains may contain a rare but severe loss. That single event can erase a long sequence of apparent success. Another method may accept many limited losses while preserving exposure to occasional larger gains. Its record may look weak for a time, even though the loss on each attempt remains contained. This is why a small sample deserves little confidence. 5 trades can flatter a weak method or embarrass a sound one. Even 20 trades may represent only one favorable sequence. The fewer observations you have, the more easily randomness can disguise itself as skill or failure. You should therefore examine results as a series, not as isolated verdicts. Track the number of trades, the average gain, the average loss, the largest gains and losses, and the longest observed losing sequence. Then ask what happens if an unusually large winner is removed. If the entire result disappears, the method may depend on rare outcomes. That dependence is not automatically a defect, but it must be understood. Also examine whether one extreme loss changes the character of the record. A high win rate can create an attractive surface, while a hidden tail carries most of the danger. The average alone may not reveal this, because averages compress very different outcomes into one number. The purpose of the mathematics is not to make trading certain. It is to prevent uncertainty from being measured carelessly. You are not trying to prove that the next position will succeed. You are asking whether the repeated proposition is favorable, how violently its results may vary, and whether the available evidence is large enough to deserve belief. But numbers only describe the outcomes a method has produced. To understand why those outcomes arise, you must next look beneath the record, at the way price searches, pauses, rejects, and moves when the market can no longer remain balanced. Price does not move simply because one side has stronger opinions. Every completed trade contains both a buyer and a seller. Price moves because transactions can no longer continue in sufficient size at the current level. Think of the market as a continuous search for agreement. When buyers and sellers are both willing to conduct business within a narrow area, price rotates. It may move up and down repeatedly, but it makes little lasting progress. That rotation is not meaningless delay. It is evidence that the present area is still facilitating trade. Balance can persist until available interest begins to thin. If buyers keep accepting higher offers while sellers become less willing to provide them, price must rise to locate new supply. If sellers continue striking lower bids while buyers withdraw, price must fall to find demand. Movement is the market's method of searching for the next area where two-sided business can resume. This explains why a level matters only through the reaction it produces. A previous high-low or congestion boundary may attract attention, but the line itself has no force. What matters is whether business can continue beyond it. If price crosses a boundary and remains there while transactions build, the market is beginning to accept the new area. If it crosses and quickly returns, the attempted expansion found too little support. Time adds important information. A brief move beyond a range can be little more than a test. Continued trade beyond that range shows that participants are willing to conduct business at the new prices. Acceptance is not proved by the first print outside a boundary. It is revealed when the market stops treating that territory as unusual. The speed of the response matters as well. A slow retreat may show ordinary negotiation between the two sides. A rapid return suggests that the auction reached an area where one side became active and the other refused to continue. The faster the rejection, the clearer the message that the market searched there and did not find lasting agreement. Repeated tests reveal another part of the process. When price approaches the same boundary several times, you should not assume the level becomes stronger merely because it has held before. Each test may consume some of the resting interest that stopped the previous attempt. If the reactions become weaker and price returns more quickly, resistance may be wearing down. If each approach is met by an immediate and forceful rejection, opposing interest is still asserting itself. You can also learn from where the market spends its time. If most trading occurs near the upper portion of a range, buyers are showing a willingness to transact close to resistance instead of demanding a large discount. If activity begins to build near the lower portion, sellers are accepting less favorable prices to complete business. Location reveals which side is becoming more urgent. Do not confuse activity with progress. Heavy trading can occur while price remains fixed, because aggressive buying is being met by equally determined selling. The important observation is not simply that participation increased, but whether that participation moved the auction. Great effort with little distance tells a different story from modest effort with easy movement. To read this behavior clearly, mark the areas where price previously found agreement, then watch what changes when it leaves them. Does trade build outside the area or retreat into it? Does the market travel easily or require repeated effort? Do tests produce weaker reactions or stronger ones? These questions keep your attention on the auction itself. Yet observation alone does not tell you what action to take. The same market evidence can support several possible paths, and none is certain. The next discipline is learning how to turn what you see into conditional decisions without turning those decisions into predictions. A trading record that shows only profit and loss tells you what happened to the account, but not what produced it. A gain may come from sound work or favorable accident. A loss may come from a weak method or from poor handling of a valid one. When those causes are mixed together, the final number cannot teach you much. Professional work begins by preserving the decision before the outcome can influence its interpretation. Record the setup as it appeared at the time, the conditions surrounding it, the intended risk, and the reason the opportunity qualified. Once the market has moved, details that were uncertain can begin to look obvious. A time-stamped record prevents later knowledge from entering the original decision. The record must also separate the plan from the action. What did you intend to do, and what did you actually do? If the two differ, the result cannot fairly evaluate the plan. A strategy may appear defective when it was never followed, or appear successful because an unplanned action happened to work. Without this separation, method and behavior remain tangled. Context gives the record meaning. A setup name alone is not enough, because the same pattern can appear under very different conditions. Note the instrument, time of day, volatility, direction of the broader move, and any condition your method considers relevant. The purpose is not to collect every available detail. It is to preserve the few variables that could reasonably explain why similar trades produced different outcomes. Use consistent labels. If one entry is called a breakout, another an expansion, and a third a momentum move, similar events may be scattered across separate groups. Loose language produces loose evidence. A small, stable vocabulary allows repeated situations to be compared without quietly changing the definition after each result. Screenshots can preserve what numbers miss. Capture the market shortly before the decision, at the point of action, and after enough time has passed to reveal the surrounding movement. The image should not replace written notes. It should verify them. A chart without an explanation invites hindsight. An explanation without a chart may omit the very condition that mattered. Review should occur at more than one distance. A brief review after the session can identify factual errors while the details remain available. A weekly review can show repetition that one day cannot. A larger monthly sample can reveal whether a pattern is persistent or merely recent. Different review intervals answer different questions, so they should not be collapsed into one hurried inspection. When reviewing, classify outcomes by cause rather than by emotion. Was the planned process followed? Was the opportunity defined correctly? Was there an operational mistake? Did an external constraint interfere? A trade can belong to more than one category, but each label should point to something observable. Bad trade is not a diagnosis. It offers no condition that can be measured or corrected. Pay close attention to repeated deviations. One departure from procedure may be incidental. The same departure appearing across several records becomes evidence of a process failure. Frequency matters because isolated events tempt dramatic changes, while repeated events justify investigation. Your records should also show what is absent. Perhaps a setup performs poorly during a particular session, or a certain condition rarely produces enough opportunity to matter. Perhaps most of the week's damage comes from a narrow type of transaction. These findings are difficult to see while watching trades one by one. Grouped evidence exposes concentration. Keep the system simple enough to maintain. A perfect journal abandoned after 3 days is less useful than a modest one completed for months. Record only information you expect to review, and review everything you choose to record. Unused data becomes decoration. Over time, the purpose of the journal changes. At first it preserves facts, then it reveals patterns. Eventually, it begins to show where the trading process loses its discipline after the position is already open, and that is where the next examination must begin. The moment a position is opened, The trade begins producing information that did not exist at the entry. Price may advance as expected, store where it should have moved, or travel far enough against the premise to make the original case doubtful. Trade management is the discipline of responding to that new information without inventing a new reason to remain involved. An entry is based on a condition you expect to develop. If that condition appears, the position is behaving properly. If it fails to appear, the passage of time becomes evidence. A trade does not have to reach a protective stop to become unproductive. When the expected movement was supposed to begin quickly, but price remains inactive, the premise may be losing relevance. Price-based invalidation is different. It identifies a location or behavior that should not occur if the trade is sound. Reaching that point does not mean the market has proved what will happen next. It means the specific reason for holding the position no longer deserves capital. The exit follows from the failure of the premise, not from a prediction about the next move. This is why an exit should be connected to the structure of the trade. A stop placed at an arbitrary distance may be so close that ordinary movement removes the position, or so far away that the original idea has already failed long before the exit occurs. The distance must reflect where the trade becomes invalid, while the position size must keep the resulting exposure within acceptable limits. A favorable move creates a different problem. Open profit alone does not tell you whether to hold or reduce. Ask what the market has accomplished. Has price reached an area where the original opportunity is largely realized? Has movement begun to slow after a clear expansion? Or is the position still developing without evidence of failure? The answer should come from the trade's progress, not from the size of the number on the screen. Partial exits can serve a purpose when the position contains more than one objective. Reducing some exposure at an initial target can lower the amount still at risk while preserving participation if the movement continues. But each reduction also removes future earning power. Selling portions without a defined reason can leave you carrying the least productive part of the trade while disposing of the strongest part too early. A trailing stop makes a similar exchange. It protects more of an established move, but it gives the market less room to fluctuate. Trail too closely and ordinary movement ends the position. Trail too loosely and much of the advance can disappear before the exit responds. The correct distance depends on the character of the movement, because a quiet trend and a volatile expansion do not breathe in the same way. Adding to a position requires even stricter logic. A lower price does not automatically make a long position more attractive, and a higher price does not automatically make a short position better. If the market has weakened the original case, adding increases exposure while evidence deteriorates. Additional size is justified only when new behavior strengthens the premise and the combined position still respects the total risk allowed. Every adjustment changes the trade. Moving a stop, taking a partial exit, or adding size creates a new exposure with a new balance of remaining risk and potential return. The question is not whether the adjustment feels protective or aggressive. The question is whether it improves the position structure under the information now available. Before entering, define the few events that would require action: failure by price, failure by time, sufficient progress, and evidence strong enough to justify any increase. During the trade, compare current behavior with those conditions. If no defined event has occurred, unnecessary intervention often adds cost without adding control. Yet even a well-managed position can begin with evidence that was never as independent as it appeared. When several signals all arise from the same source, apparent confirmation can become one of trading's most convincing errors. A chart can show 5 reasons to take a trade when in truth it is showing the same reason 5 times. The indicators have different names, colors, and formulas, so the agreement appears powerful. But if they are all derived from the same recent price movement, they are not separate witnesses. They are echoes. Consider a moving average crossover, a momentum oscillator, and a rate of change reading. Their calculations differ, but each may respond to the same upward sequence in price. When the sequence strengthens, all 3 turn bullish together. The apparent confirmation comes from one underlying event being repackaged through several formulas. This matters because confidence should rise only when new evidence adds information. If 4 signals depend on the same input, their agreement does not make the underlying observation 4 times more reliable. When that input changes, all 4 can fail together for the same reason. The problem becomes harder to see when indicators respond at different speeds. A fast tool may turn first, followed by a slower one several bars later. That delay can create the impression that a second opinion has arrived. In reality, the slower calculation may simply be recognizing the same move after more data has entered its window. Some tools also share hidden assumptions. 2 indicators may both treat recent prices as more important than earlier ones. Others may both define an unusual move by comparing it with a recent average. Even when their formulas look unrelated, they can remain dependent because they react to the same condition in nearly the same way. More indicators can therefore produce less clarity. When every tool measures a variation of momentum, the chart becomes highly sensitive to momentum and nearly blind to everything else. Agreement looks strong because disagreement has been designed out of the system. This creates false precision. One indicator becomes positive, another crosses a threshold, and a third changes color. The exact alignment may feel selective, yet it can occur only after the shared input has already moved far enough to affect every calculation. The trader has not necessarily discovered stronger evidence. The trader may simply be waiting for several delayed descriptions of the same event. To test for redundancy, ask a plain question of every signal: what new fact does this tool contribute? If the answer is merely that price has recently risen, fallen, accelerated, or moved away from an average, place it in the same information family. Different formulas do not guarantee different evidence. Then compare signals by function rather than by appearance. One tool may describe direction. Another may describe the level of activity. A third may measure the variability of movement. A fourth may identify when the observation occurred. These dimensions can still relate to one another, but they do not begin with exactly the same question. You can also examine how signals behave across past observations without judging whether they made money. Mark the moments when each one changed state. If they repeatedly turn together, remain aligned, and reverse together, their contribution may be largely duplicated. If removing one tool leaves every decision unchanged, that tool is probably adding decoration rather than information. Reduction is useful here. Keep the clearest representative of each information family and remove the rest temporarily. The purpose is not to make the chart bare. It is to make the reasoning visible. You should be able to explain what each remaining input measures and why the decision would be weaker without it. Independent evidence does not mean guaranteed agreement, and disagreement is not a defect. If 2 genuinely different observations sometimes conflict, they are preserving information that would otherwise be lost. A method that cannot tolerate conflicting evidence may be filtering for certainty that the market cannot provide. Once duplicated signals are removed, the remaining mistakes become easier to identify. You can begin to see whether the weakness lies in the analysis, the action, the preparation, or the way the method is being practiced. And that is where real trader development starts. A trader can work hard for months and remain unchanged because effort has been spread across too many weaknesses at once. New setups are studied, rules are rewritten, tools are added, and routines are adjusted. When results change, there is no clean way to know which change mattered. Development requires isolation. Before improving an error, you must identify what kind of error it is. A failure of analysis is different from a failure of execution. A broken rule is different from inadequate preparation. They may produce the same financial result, but they do not have the same cause and cannot be corrected by the same practice. An analytical error means the market information was interpreted incorrectly under the method's own definitions. The trader may have classified the condition poorly or applied a setup where its required features were absent. The remedy is not faster action. It is repeated classification work until similar situations can be distinguished reliably. An execution error occurs when the intended action was clear, but the order was carried out poorly. The market read may have been valid, yet the practical action did not match it. That weakness requires rehearsal of the specific task, choosing the proper order, entering the correct quantity, and acting within the intended time. A rule violation is different again. Here, the method and intended action were both known, but the trader departed from them. Rewriting the strategy does not solve that problem, it only changes the instructions. The useful question is narrower. Under what exact circumstance does compliance break, and what control can prevent that departure? Preparation failures occur before the opportunity appears. Important levels may be unmarked, scheduled events overlooked, or the list of eligible instruments left undefined. Once the session begins, these omissions create rushed decisions. More chart study during market hours cannot fully repair work that should have been completed beforehand. The first task is to find the dominant error class, not the error that feels most embarrassing, and not the one seen in the latest trade. Look for the category responsible for the greatest repeated damage. Improvement becomes faster when attention is placed on the main constraint instead of divided equally among minor faults.